Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, June 4th, and you, of course, are tuned into On Trend. Today, I'm going to start and I'm going to work with the StockChartsACP, the advanced charting platform. We'll look at the S&P 500 as it toys with the 200-day. I'm going to show you a slew of negative charts, show you some ETFs that held up in May, and finish with some stocks. So note that I am going to start out on the StockCharts interactive charting tool called ACP, and you can see up there at the top on your browser sometimes you're going to see the ACP link there, and it's really simple. It's just StockCharts.com/ACP, and sometimes there's also a button there on your members dashboard, which I'm at right now. And so this is for StockCharts members to get a preview look at our ACP. And so I'm going to go ahead and work from that at the beginning of this presentation. So here I am on the ACP, the advanced charting platform here at StockCharts.com. And if you need any help on learning all the buttons and how to work it, it's pretty intuitive. I mean, once you start playing around with it, you're going to get the gist of it pretty quick. But on the left-hand side there at the bottom, there is an I button for instructions. And you can click on that link and you'll get a tutorial on using the StockChartsACP. So back on this, one of my favorite buttons here and things to use on the ACP is up there at the top right there. You can see we've got the scrunch button there, and I'm going to click on that. And when I clicked on that button, I can use the mouse wheel to scroll in and out of the chart. So I can easily get a longer term outlook. Here I've got 3 years, or I can zoom in to just a couple of months. And I find that is really handy for getting instant perspective. So we're going to start our analysis with the S&P 500, and I'm going to show you some negative things that are happening in the market, because there's no doubt, there are a lot of negatives going on. But let's face it, you know, the index hit a new high about a month ago and is down around 7% from that high. And prior to hitting that new high in May, it was up like 27%. So that's a new high. And then this advance that we had here was like 27%. And now we've got a decline of 7%. So if you look at it from the perspective of the S&P 500, it's still a garden variety decline. Okay, yes, we're below the 200-day. Yes, the 200-day moving average turned down. The breadth indicator tables that I showed on Friday, members only behind the paywall, are split. So we still haven't had that big bearish signal in the S&P 500 yet. Now, as far as analysis here is concerned, what we've got the index breaking below the 200-day. Now, sometimes the 200-day is a real battle zone, especially for the S&P 500 in particular. And I think that is just because so many people, investors, traders, what have you, hedge fund managers, portfolio managers, analysts, watch the S&P 500, and if there's one moving average that is watched mostly, it's the 200-day. So you got the most widely followed benchmark for U.S. stocks, you got the most widely followed moving average, and you put them together and it's kind of a self-fulfilling prophecy. But you do tend to get battle zones around the 200-day. You can see we broke below the 200-day in March, and it didn't last long. We moved right back up to new highs. And you can see we had this little battle zone around the 200-day in October, and we went down after that. And we had to move back above the 200-day, but it didn't last long. And we moved down below, and then we had another attempt to get back above the 200-day in late November, early December, and it didn't last long. And that, of course, led to that December plunge. But in general, below the 200-day is riskier, so to speak. Above the 200-day is less risky. Incidentally, on Thursday, I'm going to go over the 200-day and show you some different combos, the close, the 5-day, 20-day, 200-day moving average cross to see how those worked in the past in Thursdays on trend. But I think, you know, we're getting oversold here. Okay, you can see that RSI, 14-period RSI, is below 30. it's at 29.91 over there on the left, you can see. And that's one of the lower readings for RSI. And so this could give way to an oversold bounce in the index here. Now, as far as patterns at work that define this downtrend here, I think we have a falling wedge of sorts, and I'm going to draw that with a line. And there you can see there's a trend line. Maybe it's turning into a flag, and I'm going to turn my little clock thing off so those stay there. And I'm using a separate program to draw these annotations here. But basically, you have a decline, you're oversold. Where do you mark support exactly? Is it that low here? Is it this low? Is it this low? Is it the 50% retracement, which I'm not going to draw here? But you get the idea. It's kind of a nebulous thing. But what we do have is we have this kind of gap below 2,800. And so we need to get back above this 2810 level to get some sort of a breakout working and a reversal of this short-term downtrend. But we could get really choppy trading because, and I'm going to show you, there are a lot of negatives that have developed over the last, in May basically. So I just showed the S&P 500 breaking below its 200-day. And another negative we have here is we are in the bearish seasonal period. And most people do the bearish 6 months, sell in May and go away. I prefer the bearish 4-month cycle. And that's because if you look at the S&P 500 over the last 20 years and you look at performance, you can see here that this period from June until September is the weakest 4-month stretch for the stock market. You put any 4 months together and you get the negative decline, negative performance. June average decline is 0.9%. September average decline is 1%. And you can see it's a 50-50 chance of advancing or declining. And then we get into the bullish period in October. And you can see May is up 65% of the time. But even so, it's flat. It's one of the weaker months historically, and that might be part to due to the decline we saw this May. But we are below the 200-day right now in the S&P 500, and we're entering the seasonally weakest period, 4-month stretch in the stock market. All right, now I'm going to move to the Russell 2000, and so I'm going to go up to the symbol box, and I'm just going to enter RUT for the Russell 2000. And we can see here that this index has broken back below its 200-day, and it is below this low there from March. So it is clearly leading on the way down, and you can see the 200-day is falling. So another negative for the stock market, we have relative weakness in small caps. And I can go ahead and use that mouse wheel to expand out. And what we can see is basically a really sharp decline, a pretty good advance, but still a lower high, a much lower high. So it looks like this is the impulse move, this is the corrective move, and now we're continuing lower. Now note there are a number of predefined lists here that you can work off for your charting. So up here on the right, I have a button for the market summary. And so I click on that button and I can see the major market, and I can click on any of these to see a chart for one of those indexes. And then I can use my mouse wheel to scroll in and out as I like. So I'm going to go ahead and close that. And what I want to show you is some of the industry indexes. And there we can see those. And the one I want to focus on is the semiconductors, SOX. And so I click on that, and we can see that SOX is leading the way lower. Now I'm going to click on that summary button again to hide that summary page. And now we can look at the SOX here because it has really taken a really hard hit. Now I'm still of the mind that we are at a potential support zone because you can see resistance there turning into support in February. So we're coming into support. If you put a Fibonacci retracements tool here, you'd be at about a 62% retracement, and there's the 200-day coming in here. So that means we could get an oversold bounce for semiconductors. How far it goes, I am not sure yet. But what we can also see is basically the SOX has gone nowhere for a very long time. I mean, here we are, October 2017, and as an index, it's right back below that October 2017 high. So it didn't go anywhere in 2018 and actually went down towards the end of the year. Got this massive rally and is now back to basically unchanged for over a year. So that is not very encouraging from a longer term standpoint. Now, another negative I'm seeing is the breakdown in the consumer discretionary sector, and in particular, the equal weight consumer discretionary sector. So this is a longer term chart of the consumer discretionary sector. And the reason I use the equal weight is because it doesn't put all that weight into Amazon and Home Depot and a few top stocks. This one weights them all equally, and so it gives you a good idea of how the sector as a whole is performing. And so you can see here, basically it's 2018 high in January, just barely bettered that in September, and didn't hold above it here in April, May there. So overall, I think this is a pretty big decline. We're below the 200-day, and the 200-day is turning down. And as far as a benchmark low, you can see we broke below that low. Now, yeah, maybe we get, an oversold bounce, but the technical damage has been done, and I think this is a negative for the market. And in that same vein, if I look at retail, XRT, we can see that it is also incredibly weak here. You can see that retail had this bounce, but it's a much lower high. So you had a big bounce, and it formed a lower high from, say, March until late April, early May, and then clearly broke a support level here. So that's another negative. You have retail really weak and leading the way lower. And another one that is disconcerting would be bonds. Bonds are surging. So if I look at TLT here, and that shows money moving into safe havens. There's a big resistance zone that was broken, and then we had kind of a consolidation here, and then a little wedge pullback there, and now we've surged. And sure, we're getting overbought, but what does that surge in bonds mean? It means that treasury yields have moved sharply lower. And so if we look at that, we'll look at the 10-year treasury yield here, and we can see it's the mirror image. All right, there you can see the 10-year treasury breaking below the 200-day and then breaking these lows here below support, kind of a consolidation after that breakdown zone, and then a continuation lower, and we're heading towards 2%. And if you want perspective, what's great about this is you can just scroll back out, and you can see we're coming into the lows from 2017 there. We're back near those 2017 lows, and treasury yields are falling because of concerns about the economy, I would guess. All right, I don't think there's signs of inflation out there because if you look at oil, oil is also falling. All right, that's another negative for the stock market. Here's West Texas Intermediate crude, and it kind of looks like retail in the fact that you have this lower high. And same with small caps. You have the big decline, and you have a big advance, but now we've clearly broken down. We're below the falling 200-day. So a downtrend in oil, yeah, it may reduce costs for companies that do have lots of energy costs. But as far as demand, maybe there's not enough demand out there. I don't know, but I would think it's not a positive for the stock market. All right, and then one other I want to show you here is the yen. And the reason I'm showing the yen is because it is the risk-off currency. And I'm using the yen ETF here. But what we can see here is that the yen basically had this breakout here. I need to move to my arrow or my line. And, it was a big wedge formation. And then we got this massive breakout there in May. And we had a little pullback to the breakout zone. This is a classic throwback to this 86 area, and now we've surged. And so the yen is breaking out and surging, and that means money is risk averse out there in the global financial markets. And I'm not even going to go into Apple and Amazon and Google because I think they've covered that ad nauseum everywhere. We all saw what happened there. And they are big stocks in QQQ, but that's also a negative out there. Now, a couple more charts that will show you the risk-off nature of the stock market over the past 5 weeks or so. The first is basically stocks relative to bonds and junk bonds relative to treasury bonds. And the way I chart those is I'm charting the ratio SPY:IEF. And so when this ratio rises, as it did here from August to December 2017, and then from April to September 2018, you're in a risk-on environment. And you can see the S&P 500 generally rose during those periods. And then when that ratio falls, you're in a risk-off environment. And that means that bonds are outperforming stocks and money prefers safe havens, and you can see the decline in the stock market. And so we can see here that in May, this ratio peaked as bonds started outperforming stocks and stocks started underperforming bonds, and it clearly broke down. It also peaked below this prior high. So we see that bonds are preferred over stocks right now, and that tells you that the market is risk averse. And then the other one is basically bonds relative to bonds. Junk bonds, the highest risk bonds out there, versus treasuries, which are the safest bonds out there. And you can see when junk bonds are outperforming, everything is fine. That shows risk taking in the marketplace. And then we see that junk underperforms from October to December. Then junk starts to outperform, and that shows risk on. And then you can see junk starts to underperform, and that shows risk off. And look at the way junk has underperformed here in May and now into June. Some serious risk off in the market. Now, when it comes to stocks, the way we can measure the risk appetite within the market is we do a ratio, or we compare the performance of riskier stocks versus the safer stocks, the low volatility stocks. So here I have the high beta ETF in the top window, the low volatility ETF in the middle window, and the ratio of the high beta ETF to the low volatility ETF in the lower window. And what we can see here is that we had some serious underperformance starting in June. High beta was underperforming low volatility from June until September, stalled a little bit, and then from October to December, we had some serious underperformance in the riskier end of the market. High beta was underperforming, low volatility was outperforming. We got some risk on from December all the way until April, but then May, everything fell apart as we went to risk off. And you can see high beta, that ratio is hitting a new low, and that shows you that the risk appetite within the stock market is not strong at all. And this is negative, and it means risk basically is a four-letter word. So what is holding up out there? Well, insurance is holding up. We saw some insurance stocks hit new highs yesterday. And if we look at the insurance ETF, we can see that it had a big surge with the rest of the market from December until late February there, had a falling flag-like correction, breakout there, and then it stalled after hitting a new high over the last few weeks. But you can see it's held above that mid-May low, so it didn't break down. So it's consolidating and it's held up relatively well. And you can see that when you look at RSI down in the lower window. Basically, you have a zone here for RSI, and you can see RSI did not go below 40 in March or in May. And a lot of stocks and ETFs had RSI going below 40 and even 30. And so you can kind of use relative RSI to gauge the pullback. And you can see the fact that insurance held that 40 zone in March and didn't break it in May means it held up much better. Next up, we have REITs, and they have been holding up well as well. We can see the breakout to new highs there with the move above those highs in late January, early February, and then consolidated with a triangle of sorts and we're getting a breakout. Even though we fell back into the breakout zone, we still haven't broken support there from that April-May low. Actually, go back to March, that low there. So holding above a support zone and above the rising 200-day. And there we can see RSI holding that zone there and not breaking below 40. And then we have aerospace and defense, which is a bit interesting. I noticed Lockheed Martin was showing some strength, and I wrote about Hexcel yesterday and don't ignore this chart. But, the aerospace and defense ETF is above its 200-day, which is either flat or slightly rising. But, after this big surge, it's formed a consolidation, and it hasn't broken back below the 200-day here in May. It's holding that mid-May low. So I'd watch for a bounce off support here and a possible breakout there in the defense ETF. And there you can see RSI. It did just break below 40 there in March, but it's held above it in May, so it's holding up much better than the rest of the market here. And then finally, the solar ETF from Invesco, TAN, is performing extraordinarily well. There you have the breakout there, and a break above the 200-day, and then the 200-day turned up there in April and May. And in the meantime, you had a pullback and another breakout, consolidation, and it looks like we're getting another breakout. Now, there are also some foreign ETFs that I want to highlight. There are two bullish setups after this. The first one here is the Harvest CSI 300 China A-shares ETF. Boy, that is a mouthful there. You can see the name up there at the top. And we can see that we've got the breakout there, and we moved very sharply higher, but then fell back very hard. And we're now in this 50 to 62% retracement zone, trying to firm here. And so I'm watching to see if we can get a bounce off this 200-day, which is turned up, and this retracement zone. Now, as potentially positive as this Chinese ETF looks, if you look at the broad cap or the large cap 50 ETF, FXI, you can see that it looks not as good clearly, because that 200-day has turned back down. Price is back below the 200-day. We didn't hold the 50 to 62% retracement zone. Instead, we moved below it. So, yeah, this one needs to get back above. I would say if it can get back above that 200-day, then that would be a very positive development for FXI, and that could be positive for the U.S. stock market and technology, because if China bounces, that could mean the market is starting to view whatever's going on out there more favorably. Now, two other promising ETFs, and I think they look more promising than the other two. The first one is Vietnam, VNM, and we can see basically a double bottom taking shape with two lows and then a breakout there above resistance, above the 200-day, and then classic technical analysis at work here. Broken resistance turns support, and we're testing that, and the 200-day has just turned up. So basically we had the big advance, and we've had a correction of some sort. And yeah, it's choppy correction, most corrections are, but it's retraced around 50% and come back to the breakout zone. So this is support potentially, and I would watch for a surge off support to signal that Vietnam could be ready to move higher. And then the other one is the Frontier 100 iShares. So this is like the emerging of the emerging markets. And if we look at this ETF here, we can see a breakout there above resistance, trending lower into 2018, but they got a big move in 2019, corrected. And what's caught my eye is it's holding up pretty good in May. It's near these highs here with the bounce. So if we can get a break out of this channel here and above this high from the early part of May, I think that's going to be a bullish development for this Frontier ETF, FM. All right, so the first stock I'm going to start off with that is holding up quite well in May at least is INCY, and I think it's got a bullish chart pattern overall. I've highlighted this one before, but Basically, you have a big resistance zone there, and you broke out with a pretty strong move that went to new highs here. And since then, we've had this pullback or throwback to the breakout zone. And this is classic technical analysis at work. You surge and break out, you throw back to the breakout zone, which becomes support. And now we're kind of consolidating with a triangle. And this is a triangle after a big advance, which makes me think it's a bullish continuation pattern that is forming above the rising 200-day moving average there. And so I'm watching for a breakout and a continuation higher for in sight. Now, next I'm going to get into some industrial stocks that are associated with the defense industry. And the first is Hexel Corp. And I highlighted it yesterday in Don't Ignore This Chart. And basically you have a big breakout there with a strong surge in January, February, and then consolidated. But what's interesting is you look at this consolidation, held up very well in May. You didn't break down to new lows or test the 200-day, and instead you actually broke out. You broke above resistance there. So this is a bullish chart configuration, especially given how weak the market was in May. Next up is Lockheed Martin, and I don't have anything special on this chart except to note, you had this big gap, and then what's interesting is after the gap, Lockheed just continued to work its way higher. So buying pressure continued. So this stock is continuing to build on actually the last breakout signal was kind of this flag wedge that we had here in March. Next up is RBC Bearings, again, part of the defense group. And what I'm noticing here is first a lot of support in that 125 area. And there's your resistance zone. And we got that big surge. And what's even more impressive is if you look at that price action in May, it was moving higher in May when the market was moving lower. So that's a lot of relative and absolute strength. And so now this stock is just above its 200-day. And I think this relative strength could lead to more absolute strength. Next up is Teledyne Technologies, also part of the Defense Aerospace Group. And we can see first a little consolidation there and a breakout to a new high. There we have a new high in April. Now it did pull back in May, so it wasn't one of the leaders in May because it fell back, but it's right at a potential support zone. You can see in this 225, 235 area. I could raise that up to conclude this consolidation here. And it looks like some sort of a falling wedges form. So I would watch for a surge off this support zone and a possible breakout to lead to higher prices for Teledyne. And finally, we have Honeywell. Now, Honeywell's not, I don't think they're in the aerospace and defense group, but they're more of a broad industrial company. But if you look at the chart overall, it's a bullish chart. Yeah, you had this, huge dip and this huge recovery, but you're back above the rising 200-day moving average. You had a 52-week high there in early May. And if you look at this pullback here, it's looking like a bit of a flag or a wedge, if you will. And we firmed for 3 days here and got a bounce yesterday. So I'll be watching Honeywell for a potential breakout and a continuation higher of its uptrend. And that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend. Have a great day.